You have 3 R's as guidelines for us. So just tell us what they are.
Well, I think, first of all, people have to re-examine their basic beliefs. And if they're working with an advisor, their belief in these things, such as buy and hold and indexing and investing for the long term, rebalancing, dollar cost averaging, and all those things, there needs to be a common definition and an agreement on how they feel about that. Do you really believe in buy and hold? Do you want to hold on to a 50% loss? And
you need the agreement with your financial advisor? Is
Yes.
that what you're saying? Yeah.
Because so many people, many financial advisors twist their clients' arms and say, no, you've got to stay with this because
Right.
it's investing for the long term. And clients look at their portfolio down 50% and panic and leave and don't do anything and park their money in CDs the rest of their life or whatever. And so that's a real problem. The second R is just simply re-examine risk. And like Jonathan said, it's a totally subjective thing. It's a relative thing. It means one thing when the market's up, another thing when it's down, and it's very hard to get a hold of that. That's why I think most portfolios should start out being conservative and then let them experience what's going on as they go along with the portfolio. And the third R has to do with redefining your financial life in light of the reality that exists in your life now. If you are down 50%, don't try to make back 100% overnight, thinking you can pick the right color or shake the dice and that sort of thing. Don't get exuberant about trying to recover something too quick because you're going to screw it up if you do.
All right. And we'll go back to some of these too, especially the investment myths, which I want to talk about with you and Jonathan in particular. So Mark, at Pershing, you deal with thousands of financial planners. And it turns out that a financial planner can be extremely risky too, a la Bernie Madoff.
Yes.
So first, how do we avoid a crook? That's my first question for you.
Well, first of all, I would say that Bernie Madoff wasn't a financial planner. So,
all right.
So there.
You're right. He was an investment advisor.
Yeah, he was a bunch of things.
This is a family
it's
program,
a family
so
program.
right.
I think that the way to think about it is that the financial community is really divided between the buy side and the sell side. And in the traditional brokerage environment, they are individuals who are sell-side oriented, meaning that their reward is going to come from the products that they sell.
Right.
On
Brokers.
Like brokers. And on the buy side, and it's not a pejorative, it's the way in which they
Right.
generate business,
Sure.
and many of them have the client's interests at heart. And on the buy side, there's a registered investment advisor, which is going to be a professional consumer making investment decisions on behalf of the clients. Those who are financial,
Vern.
like Vern, and those who are financial planners like Vern will also be doing investment recommendations in a context. So it's evaluating things like risk, not just risk in investing, but risk management from an insurance standpoint as an example, which might be important. It might be lifestyle issues or what you want to do from a philanthropic standpoint. So the question is, how do you know if it's a crook?
Right.
I don't know if there's a true smell test, but one of the things that's probably true that's occurred with all of the people that have been in the news over the last couple of years is some of the responsibility is borne by the clients themselves. And I think that for individuals to abdicate responsibility, after all, it's their money.
Right.
And to believe that outsized returns is great while it's going up, but to get mad while it's gone down or lost is somewhat irresponsible on the part of the individuals themselves. So much like you would in the case of going to a doctor, it's always a good idea to find out if there's a diagnosis or a symptom that you begin doing some research on your own to begin understanding what could this possibly mean. Part of this is being able to make informed judgments and to smell a rat when it's a rat.
Mm-hmm.
So unfortunately, it's intuitive. That said, one of the things that investors can do is ask the question of their broker-dealer or the registered investment advisor whether they are self-clearing or custody themselves, or whether they're using an outsource firm
like Pershing,
mm-hmm. to protect them. And the reason for that is firms that are self-clearing do not have a second set of eyes to take a look at their business. So if the firm is using an independent custody firm or an independent clearing firm, there is a vetting process that we go through at Pershing, for example, to make sure that the firm is adhering to certain processes, that if there's unusual activity that's happening into accounts, it's one of the things that we monitor.
Right.
So all of these elements are in place because there's an independent party whose interest is to protect the client.
Very, very good point. And thanks to that, I've just learned a lot about how that the industry works. Jonathan, so how do we rebuild our financial health without taking on a lot of risk? I mean, what Vern was just saying is, you don't want to try to make up that 50% loss by doing some stupid things. But how do we rebuild our financial health without taking undue risks?
Well, you think about the mistakes that people made, right? I mean, they bet too much on technology stocks. That didn't work out well. They bet too much on real estate. That didn't work out well. They stopped saving. That didn't work out so well, and they took on a mountain of debt. So maybe they shouldn't do these things. So one, maybe you should diversify broadly. Forget making the big bet on, one asset like technology stocks or like real estate. Instead, diversify broadly. A lot of 401k plans, they made it the default investment option, these target date retirement funds. If you can't control yourself, if you're making all these big undiversified bets, maybe you should buy a similar sort of investment offering where your money is spread over a broad array of assets.
Right, and somebody else is doing it for you in the case of a target date fund. Yeah.
Second, we used to have this old-fashioned notion that, when you retired, you wouldn't have any debt. Well, maybe we should go back to that notion. Maybe people take on some debt initially when they buy their home, and then they work to pay it off. Forget this notion that, you can live with hundreds of thousands of debt all the time.
Right.
You want to get that paid off for retirement. And third, we need to go back to saving money. In January and February, the savings rate got above 4%. It's the first time that we've had it that high since 1998. There's some indication that people are starting to relearn saving. And, we need more of that. We need the savings rate to get back up towards the 8, 9, 10% that we've seen historically.
Now, there was a notion that you were saving when you were investing in the market, or when you were, investing in technology stocks, or when you, bought a house, and even because it would keep going up. So is there a real distinction between savings and, your savings and your investments?
Yeah, I mean,
is that an important distinction?
One of the things that people got tremendously deceived by, they would buy a home and it went up a lot in value, or they bought some technology stocks and they went up in value,
right.
And they said to themselves, oh, I don't need to save because I own this asset that's gone up a lot in value. But remember, if you own an asset that goes up a lot in value, what you're often doing is borrowing from the future. If you have great returns this year, it probably means you're not going to get great returns next year. So instead of stopping saving, you want to keep saving. Maybe you take that money, you don't save it in the asset that's doing tremendously well. Maybe if stocks are doing really, really well, maybe you put your fresh savings into bonds instead.
Vern,
yes.
One of the things that you just mentioned in your 3 R's is to kind of reassess your investment beliefs.
Mm-hmm,
and I mean, so there are myths that you think that there are myths that have been kind of destroyed.
Right.
So what are the myths that we should discard? Investment myths that we should discard?
I think buy and hold is a myth. I think people need to think about that. When you look at the average mutual fund, their turnover is about 80 to 100%.
Right.
And they certainly aren't buy and hold, and they're some of the smartest people in the world managing money.
Mm-hmm.
And so why should I be a buy and hold and hang on to a 50% loss? And I think it's a mistake to do that. A lot depends on how the money is invested. If you've got a decent offense and defense, you may be able to hold that kind of position a lot more, but in times that we've just experienced, come back on the offense and take the defense off the bench, so to speak, and make it more of an active role. And that's what we do. Indexing, I think, is another myth. I don't think you should index because it works beautifully in up markets and terrible in down markets. Now I know Charles Ellis is a great guest here. I've seen him. You interview him, and he's fabulous. And he's written a lot of the classic work on asset allocation and
Winning
everything.
the Loser's Game.
He also wrote a book called Capital. In that book, he said that had you been invested in certain American funds by Capital Research, you would have been better off than indexing. And Burt Malkiel wrote the foreword to that book. And so there are exceptions to the indexing philosophy. It worked great in the 90s, and then it fell apart, in the bear market. And I think people have to make that up. The indexes would have lost 80% if you put the two bear markets together in the last 10 years. And it's tough to make it up.